Hi, I'm Peter Mallouk. Welcome to 1,000 Miles from Wall Street. I'm here with Candace Varner, the head of our tax practice, and Ben Hake, our tax director. And we're going to talk about things taxpayers should be doing now. And it's an interesting time of year to be talking about that because it's basically summer, and no one wants to talk about taxes in the summer, which just shows how prepared you two are. So I love that this is your topic for today. So Ben, let's talk about what it is that you think people should be starting to think about this early.
You know, this early in the year, the big thing is kind of looking at where their income is coming from and are they in a great position for that. So a lot of our clients, the first thing we're trying to get in front of is their withholding, which really was magnified this year with the tax law change. But specifically, a lot of people found out that their withholding wasn't keeping up with their liability. And that's kind of what you were hearing about in the news with people owing tens of thousands of dollars. So it's much easier to get in front of that now when we've still got months to get that adjusted versus finding out about it in April and trying to scramble to find the funds. So that's definitely the first place we're looking at. And the next is to see if we could take advantage of any deductions. So for a lot of our clients who are tax or wage earners, we're looking at are they taking advantage of employer-provided benefits like retirement plans, health insurance, things of that nature. And then for our self-employed individuals, it's taking a look at seeing what sort of deductions they can qualify for or expenses they might be able to incur that help them make more money and have less taxable income to the IRS.
And Candace, when you think about doing that, obviously you're looking at standard deduction versus itemizing. So what are some key things people should be thinking about there?
When I look through a tax return with anybody, I want to look at what things on here can we control and what things can we not. By the time we get to March or April, there's a lot we can't do anymore. It is what it is. So that really emphasizes the planning. With the higher standard deduction this year, we're talking to a lot of people about bunching their charitable deductions into specific years, so they'll go over that in that 1 year, or looking at their mortgage interest. If they're taking the standard deduction, they're getting no tax benefit from that anymore. So they might want to look at making some changes to their loan structures, or really anything else that's in there that they have control over. And if I could jump back to his withholding point for a moment.
Oh, I love it. You're going to correct Ben?
No, I'm not going to correct.
You're just going to expand upon it. All right. That's
the one thing which he tells me all the time is that for a lot of clients, the withholding issue really comes in with their incentive pay. So it's one thing if you earn the same paycheck every single 2 weeks or whatever it is, your withholding is probably a little bit close. But if you ever get a bonus or restricted stock or anything else that's kind of a lump sum, the withholding on that is usually 25%. That's just the standard. It doesn't matter what your W-4 says. And that's
just pretty much not what anybody owes.
Exactly. So it gets a lot of people into trouble where they think, well, I already paid taxes on that, and you didn't really. Right. So that's...
Right. You either have overpaid or underpaid.
Right. But you're never spot on.
Right. And so in terms of capital gains, obviously we manage money here, and a lot of our clients have real estate and businesses, like Ben said. So how should people be looking at that and thinking about that from now?
They're going to want to look at a couple things. One, when you're selling something, if it's going to trigger a capital gain, you want to know not just if it's a position you want to change and the financial aspect, but also the tax implications. And the capital gain specifically is one where it's really a one-time thing. It's not happening all the time. And so you really want to be careful about when you're triggering those and look at specific hard cutoffs on your income. So a lot of people are looking at situations where their Medicare premiums might be increased or an additional surtax would apply or those kind of things over exact dollar amounts on their taxable income line. So we want to be cognizant of that when choosing which year and when to trigger those.
And I've noticed a lot of clients, again, I think because it's complicated, they think certain losses offset gains, but not all gains go against all losses.
Right. Capital gains are kind of their own bucket, and they'll offset each other. But at the end of the day, if you have a capital loss, you only get to use $3,000 a year against other income, which is hardly anything.
Yeah, so you really want to ideally have the gains somewhere else to offset it.
Right.
And are there thresholds, Ben, that people should be looking at as they're starting to do their planning and looking at the returns?
The big ones that we normally focus on are actually on either side of the spectrum. So we've got a few clients who have retired and maybe before Social Security and other items have started, they've got low income. So there's actually the opportunity to realize some gains within their portfolio and pay 0% versus 15%. And that's normally for a married couple about $76,000. And then for the higher end of the spectrum, we're normally looking to, if possible, avoid the 3.8% surtax, which applies at $250,000 of income. So we've kind of got both aspects where we can either make some income and pay very little or keep our income low to pay less.
Okay. And then I know a lot of people, just because I see this a lot, they come to you to do their taxes. And obviously you're doing year-end planning with people, but a lot of times we find out somebody's CPA is retired, they're switching their taxes to creative planning, it's February, and they're coming to you and going, what deferral plans can I put together to avoid taxes? So why don't you just talk about when you have to do those things and what kind of plan plans are available?
Each plan's a little bit different. For retirement plans specifically, the only thing we can really affect after the end of the year is if you're self-employed and you're going to open or contribute to a SEP IRA. Everything else we need to do before the end of the year. Well, I guess IRAs, sorry, I missed that. But I'm thinking 401ks or other things like that. A lot of those have employee deferral pieces, and that has to be done before 12/31.
Right.
Not just created, but actually the money has to be in those accounts.
Right.
When we get to the tax return, we're a little more restricted on the SEP IRA, a traditional IRA. We can still contribute to HSA plans for health savings, and then 529 plans for college. That all has to be done before the end of the year as well.
All right, so my main takeaway is someone should be sitting down like with somebody like the two of you right now, earlier in the year. I don't want to cause your phone to ring off the hook, but they should be planning from now
Yes.
and basically figuring out where should I be deferring money, where can gains offset losses, am I heading towards a path towards itemization or not, and you start to lay out a plan that you don't have any surprises at tax time and you're not paying any taxes that you could have avoided.
Exactly.
Thanks for being with us.
You're welcome.
This commentary is provided for general information purposes only and should not be construed as investment, tax, or legal advice. Past performance of any market results is no assurance of future performance. The information contained herein has been obtained from sources deemed to be reliable but is not guaranteed.